Global equities struggle lifting the safe haven greenback. Wall Street equities fell on Tuesday as risk aversion re-emerged amid fresh COVID restrictions in Europe and around the world. Adding to the negative tone in the markets, Treasury Secretary Janet Yellen said that the U.S. economy remains in crisis, while the potential tax hikes to pay for Biden's $1.9 trillion relief bill weighed on investor sentiment as well. As a result, the S&P 500 index fell 0.76%, the Dow Jones shed 0.94%, while the Nasdaq sank 1.12%. On Wednesday, Asian stocks finished broadly lower amid a deterioration in the outlook for economic recovery after European governments extended anti-coronavirus lockdowns. Furthermore, the World Health Organization said that the weekly global death toll from the virus is rising again, following 6 weeks of declines. Against this backdrop, Japan's Nikkei 225 fell 2.04%, Hong Kong's Hang Seng Index slid 2.03%, the Shanghai Composite declined 1.3%, while Australia's S&P ASX 200 bucked the trend to gain 0.50%. In Europe, equities struggled initially against the backdrop of new restrictions in the region, while upbeat economic data helped ease the concerns somewhat. Also, chip makers were leading gains after positive news from U.S. chip-making giant Intel. The company's shares surged more than 6% after hours as it announced aggressive plans to expand its manufacturing capacity and to take back its leadership position in the industry. On the data front, the Eurozone Manufacturing Purchasing Managers Index improved from 57.9 in February to 62.4 in March and beat the predicted reading of 57.7, hitting the highest on record. The bloc services PMI jumped to 48.8 versus 46.0 expected and 45.7 last. In Germany, manufacturing PMI came in at 66.6 in March versus 60.8 expected and 60.7 prior, while services PMI unexpectedly expanded to 50.8 in March versus the previous month's reading of 45.7 and 46.2 anticipated. On the negative side, Germany's IFO Institute slashed its forecast for economic growth this year, citing its extended lockdown. The IFO cut the 2021 growth forecast for Europe's largest economy to 3.7% from 4.2% previously. At the same time, the institute raised its GDP growth forecast for 2022 to 3.2% from 2.5%. As such, following the initial losses, most regional stocks turned lower by the end of the session. The Stoxx Europe 600 index gained 0.02%, the French CAC 40 recovered 0.03%, the FTSE 100 added 0.20%, while the German DAX dropped 0.35%. Meanwhile, Wall Street indexes closed lower overnight for a second straight day in a row, despite the 10-year and 30-year Treasury yields were both being slightly lower. On the data front, durable goods orders decreased by 1.1% in February, following an increase of 3.5%, while the market composite PMI fell to 59.1 in March from 59.5. The market manufacturing PMI climbed to 59 from 58.6, and the market services PMI increased to 60 from 59.8. Elsewhere, Treasury Secretary Janet Yellen and Federal Reserve Chairman Jerome Powell reiterated their belief that the U.S. economy will see marked growth in 2021 thanks to fiscal and monetary stimulus. As such, the Dow Jones Industrial Average closed 0.01% lower, the S&P 500 index fell 0.55%, and the tech-heavy Nasdaq Composite shed 2.01%. As for currencies, the dollar extended its broad-based rally due to its safe haven status. Upbeat economic data added to the positive tone surrounding the greenback as well. As a result, the Euro-USD slipped further and was nearing the 1.1800 support zone early on Thursday. Of note, the pair has settled below the 100 EMA, suggesting the path of at least resistance remains to the downside. Elsewhere, oil prices erased previous losses on Wednesday to close just below the $64 figure, as signs of stronger gasoline demand in the U.S. eased concerns around the global economic recovery from the pandemic. A U.S. inventory report showed domestic fuel consumption is at the highest in 4 months, and Gulf Coast refiners are increasing their appetite for crude. Meanwhile, crude inventories rose by 1.9 million barrels in the week ending March 19th to 502.7 million barrels, the Energy Information Administration said on Wednesday. U.S. gasoline stocks rose by 203,000 barrels in the week to 232.3 million barrels, compared with expectations for a 1.2 million barrel rise. That is all for today. Thank you for watching. Please click subscribe to always be in touch with the latest market news.